Here's a question I never thought I'd ask. When did the company that makes bulldozers become an AI stock? Caterpillar just booked 4 separate 1 gigawatt generator orders for data center campuses. That's enough power to light up a small city.
And that's on top of a $51 billion backlog, up 71% in a single year. This isn't your grandfather's equipment company anymore.
Welcome to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we're breaking down Caterpillar, ticker CAT, one of the most iconic industrial companies on the planet that's suddenly at the center of the AI infrastructure story. Lana Chen is here to dig into the numbers.
Let's get to work.
Caterpillar was born in 1925 from the merger of Holt Manufacturing and CL Best Tractor Company. For 100 years, they've been building the machines that literally build the world. Excavators, bulldozers, mining trucks, diesel engines, gas turbines, even locomotives.
The business runs through 4 segments. Construction Industries builds the classic yellow iron for building sites. Resource Industries handles the massive mining equipment. Energy and Transportation covers engines, turbines, and power generation. And Financial Products provides the financing that makes those multi-million-dollar equipment purchases possible.
They operate through 161 independent dealers in over 190 countries. That dealer network is arguably the most powerful moat in heavy industry. Exclusive territories, deep customer relationships, and parts and service ecosystems that make switching to a competitor painful and expensive.
And CAT machines hold their value better than anything in the industry. 10 to 15% higher resale values than competitors, with equipment lasting 20 to 30 years. When your used excavator is worth more than a competitor's new one, that creates real pricing power.
The company just relocated headquarters from Peoria, Illinois to Irving, Texas, and employs about 51,600 people. Revenue hit a record $67.6 billion last year, and the stock has nearly tripled from its 52-week low. There's a new name at the top. Joseph Creed took over as CEO on April 1st, literally days ago. He was promoted from Chief Operating Officer, succeeding Jim Umpleby, who moved to Executive Chairman.
The transition is about as smooth as it gets in corporate America. Umpleby's tenure was exceptional, 68% total sales growth and earnings per share that grew more than 6-fold. Creed brings deep operational expertise from running the day-to-day, and Wall Street sees this as a continuity play, not a disruption.
The market clearly agrees. The stock barely moved on the announcement, which in CEO transition world is the best possible outcome.
Let's talk about what's under the hood. Caterpillar trades at $721 with a market cap of $337 billion. On a trailing basis, that's 38 times earnings and about 5 times sales.
How does that compare to CAT's history?
It's rich. The 10-year median PE for Caterpillar is about 18.5 times, so we're at more than double the historical average. That tells you the market is pricing in something beyond a normal cycle, specifically the AI data center and mining supercycle narrative. Trailing revenue was $67.6 billion with earnings per share of $18.83. Look at the quarterly trajectory. $14.2 billion in Q1, $16.3 in Q2, $17.6 in Q3, and then $19.1 billion in Q4. That's a company accelerating through the year.
What about profitability?
Gross margins are 33.8%, which is healthy for an industrial. Operating margins came in at 16.5% for the full year. Free cash flow was $8.9 billion on operating cash flow of $11.7 billion. The balance sheet carries $10 billion in cash against $30.7 billion in total debt, though a big chunk of that debt sits in the financial products segment, where leverage is the business model. They also pay a dividend yielding about 84 basis points. Overall, Caterpillar's financial health is solid. Record revenues, strong cash generation, and manageable debt, though margin pressure from tariffs is the key watch point.
Where do analysts come down on this one?
26 analysts cover the stock, 15 buys, 10 holds, and just 1 sell. The average price target is $736, which implies about 2% upside from current levels. That's tight. The range goes from $425 on the low end to $878 on the high end.
So the consensus is basically saying it's fairly valued right here.
Pretty much. HSBC is the most bullish recent call. They raised their target from 660 to 850 with a buy rating, citing data center power demand and the record backlog. Wells Fargo went to 870 overweight, pointing to autonomous mining and infrastructure catalysts. Wolfe Research raised to 750 outperform, but kept a tighter leash.
Last earnings were January 29th. Q4 revenue hit $19.1 billion, a record single quarter, and adjusted EPS came in at $5.16, both beating estimates. The guidance for fiscal 26 called for about 7% revenue growth, but it came with a major caveat: $2.6 billion in incremental tariff costs.
That tariff number is what keeps this interesting. Margins compressed from 20.7% to 17.2% over the past year, partly because of tariffs. The company says they can offset it through pricing and cost reduction, but that's the number one risk to monitor heading into the April 23rd earnings.
The bull case for Caterpillar starts in an unexpected place: the data center. The power and energy segment grew 44% year over year, and CAT has landed 4 separate 1+ gigawatt generator orders for AI campuses. They're planning their largest factory investment in 15 years to meet this demand.
Bulls also love the backlog story. $51 billion, up 71%, with 62% expected to convert within 12 months. That's the kind of revenue visibility that industrial companies almost never have. Add the mining supercycle. Copper and gold demand for electrification, 690 autonomous trucks deployed, a new NVIDIA partnership for digital twins, and you've got a multi-year growth runway.
The bear case centers on tariffs. $2.6 billion in incremental costs is not a rounding error for a company with 16.5% operating margins. If tariffs escalate further or pricing can't offset the hit, margins compress and the growth story gets complicated.
And then there's China. The construction market there has weakened materially as the real estate sector struggles. Demand for large excavators, historically a key revenue driver, has been declining. Pair that with the cyclical nature of the business and a valuation that's double the historical average, and you have a stock that needs everything to go right.
This is also a company where the backlog sounds incredible until you realize capacity constraints may limit how fast they can actually convert orders to revenue. Let's see how CAT stacks up against the industrial heavyweights. We're looking at Deere, PACCAR, and Cummins.
Deere trades at about 35 times earnings and 3.8 times sales, growing revenue around 5%. They're diversified across agriculture and construction, but facing headwinds in the ag cycle. PACCAR is at 20 times earnings and 2 times sales, less than half CAT's PE, but they're a pure-play truck manufacturer that's more cyclical. Cummins sits at about 24.5 times earnings with a diversified powertrain business.
So CAT is trading at a premium to all of them.
A significant one. The premium reflects the data center growth catalyst and the autonomous mining narrative, but it also means CAT needs to deliver faster growth than peers to justify the valuation gap.
What are options traders telling us heading into that April 23rd earnings?
The put-call ratio is 0.94, essentially neutral with a slight bullish lean. What's really notable is the implied volatility percentile sitting at just 4%, meaning IV is near its annual floor. Heading into the earnings event, the put-call ratio spikes to about 1.4, indicating institutional hedging. Call activity clusters around 750 to 800, the upside bet range, while puts concentrate at 650 to 680 for downside protection. The low IV environment means options are cheap, which could create a volatility expansion if the earnings surprise in either direction.
How are the insiders positioned?
This is a yellow flag. CFO Bob DeLange sold over 26,000 shares worth $18.2 million in February. CEO Creed sold roughly 3,000 shares worth $2.3 million in March. Over 2 years, net insider transactions are negative $155 million. One director bought about $570,000 worth this year, but that's a drop in the bucket compared to the executive selling.
Again, a lot of these follow pre-planned trading programs, and executives often sell after equity compensation vests. but the overall pattern of zero aggressive insider buying at these levels is worth noting. So what should investors watch going into the next few months?
Watch China construction data and any escalation in trade tensions.
What's the verdict on Caterpillar?
This is a 100-year-old company that has somehow found itself at the center of two megatrends: AI infrastructure and the mining supercycle. Record backlog, record revenue, and a new growth engine in data center power generation. The execution under Umpleby was outstanding, and the transition to Creed looks seamless.
But the valuation is telling you the market already knows this story.
Exactly. At 38 times earnings, double the historical average, you're paying for excellent execution that hasn't happened yet. The tariff headwinds are real, China weakness is real, and this is still fundamentally a cyclical business. The key metric to watch is operating margin trajectory. If margins can hold above 16% through the tariff storm, the stock works. If margins compress below 15%, the premium unwinds.
Let me close with a quote from the new CEO, Joe Creed. He said, "These results demonstrate the strength of our end markets and our disciplined execution. With a record backlog, we enter the new year with strong momentum."
It's the right message for the moment. Confidence without overreaching. The execution has to match the words, and April 23rd will be the first real test under his watch.
That's going to do it for episode 77 of Charged Alpha, our deep dive into Caterpillar Inc. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.